Welcome digital asset fans. We're going to dive into an exciting video from Kitco News. We're going to hear from Luke Gromen. He is the founder and president of FFTT LLC. He states some things that I've been stating on this channel for a while. He doesn't believe that the US dollar is going away. He believes it's going to be revalued. He also believes that there's going to be a massive impact on gold, silver, and Bitcoin. There's also going to be something interesting that he said. He said that there's going to be a massive dump of U.S. treasuries before the end of the decade. So we're going to dive into this video. I'm also going to speculate some. So if you are a fan of these digital assets, if you're a fan of XRP, XLM, and other great assets that are talked about on this channel, go ahead and subscribe, hit the like, and share with friends and family. Because the more people that learn about these assets, the more people can invest. If you haven't purchased a hardware wallet to keep your valuable assets offline, you're gambling. Now is the perfect time to do it. Through Token Topics affiliate links, you can receive an unbelievable discount. Go ahead and check it out. Now, you can store a wide range of different assets. You know, I like to talk about XDC, XRP, HBAR, and several others that's on this channel. You can store all those awesome assets, including, of course, Bitcoin and Ethereum, safely offline on a D'CENT wallet. Go ahead and check out the affiliate links in that discount. Enjoy. Now, before I dive into this video, I just want to state that the dollar is not going to die like some people might think. I mean, it's not going to be the same dollar that's being used today. There are major changes going on around the world. And there's a lot of nations that are tired the way how the West has been running things and abusing the Swiss system. And the dollar right now is completely overvalued, especially with, you know, the United States government just printing money like it's nothing. And when you do that, it loses its value. So what we're seeing right now is like fantasy economics, and this is unsustainable. And the whole infrastructure of the financial system, you know, everybody that's been paying attention, they know that it's being reconstructed, you know, before our very eyes. We have the BRICS nations. We see how the BRICS nations have formed together to get off the dollar. They're tired of the way how the West has been running things and the Swiss system. But those who have been paying attention, like I was saying, they see that the entire plumbing of the financial system is being reconstructed. The introduction of CBDCs is a very hot topic right now. The tokenization of real-world assets, everything being on-chain, is going to be a reality here soon. We're going to see an influx. We're going to see it at a rapid pace, I'd say between next year by the end of the decade. And this is really happening, you know. And the sad part, it's an incredible time to be alive, but at the same time, it's kind of an alarming time to be alive, especially when we see what's going on with Russia and Ukraine and the tensions between the United States. And these are very turbulent times. You see a black swan event just on the horizon, but I think if we do see a black swan event, it's going to be on a global scale, and it's going to shock the world. Now, what that black swan event is going to be, that's to be determined. Alright, so I want to play this clip from Kitco News. We're going to listen to Luke Gromen, who is founder and president of FFTT LLC. He states that the dollar is widely overvalued, and there's going to be massive impacts on precious metals like gold, Bitcoin, and we're going to see a massive dump of U.S. treasuries between around now and by 2030. Let's go ahead and hear what he has to say during these incredible times we're living in. Now, before I begin this video, keep in mind that there is still a large population that's in the dark about the technology that's going to be used to move value around. Keep in mind that you can actually transfer Bitcoin, the value of Bitcoin, through the XRP ledger. It's pretty incredible. I believe you can actually do that through the XDC network as well, through Impel. So transferring Bitcoin, why would somebody want to waste their precious Bitcoin if they're storing it when they could transfer it through these other technologies and save? It's also going to be faster. So there's a lot of people in the dark about how this is actually going to unfold, But the way it's going to unfold is going to be extremely interesting. It could be a store of value in itself, but as far as moving value around and moving even gold around, the technologies of choice as far as American technology is going to be what Ripple is doing with the XRP ledger and what Stellar is doing with the Stellar network. As far as gold, if you've been subscribed to this channel, I stated for some time that there could be a reality that we see gold coming back as a gold standard. Anybody that's been paying attention to the BRICS nations knows that BRICS is very much pro-gold. So we are at the point in humanity where we have the technology to move that value around at the speed of information. It's incredible. So if somebody was wanting to know my personal opinion, I do believe that we are going to go back to gold. Gold worked excellent in the past. It's just that it's not practical to transfer that value. But now, as I stated, we have the technology to do so. So bringing this back could really mean a stable global economy. But the only thing is, of course, you need everybody on the same page. But again, going back to gold, price of gold. If gold is the world's reserve, what would be the technology behind that to transfer that reserve currency? Let's go ahead and dive in and hear what he has to say.
The thesis is that U.S. Treasuries no longer have the dominant position of the global reserve asset for central banks. Now, currently, currently it's 58%. The dollar share of global reserves is at 58% as of Q4 of 2023, according to the IMF. Now, we just started this interview by saying how China is selling its U.S. Treasuries. But beyond China, what do you see happening with central banks to make the U.S. Treasury bond lose its position as king of the global reserve central bank assets?
Yeah, I think the reason why the U.S. Treasury market is losing its share as primary global reserve asset, and we can see that since 2014, global central banks have sold $400 billion of treasuries on net, and they've bought $600 billion worth of gold on net. So from a marginal perspective, for the last 10 years, central banks have bought gold and sold treasuries. The reason I think this is happening is multiple. Number one, for the reasons I just highlighted, some of it's mechanical. When the dollar gets too strong, you sell what you can to raise dollars, not what you want to. That's treasuries. Number two, some of it is geopolitical. Treasuries for central banks are no longer risk-free instruments. If you do something the United States government doesn't like, they will take your treasuries, full stop. They've done it to Russia. They've done it to others. And that has opened eyes. The third point is a little more subtle, but it is in a world where you have peak cheap oil, which is to say we're not running out of oil, but we're running out of cheap oil. It costs more and more to find marginal barrels of oil. When we're in a peak cheap copper world, where again, we're not running out of copper, but the copper we find, the prospective supplies are much, much higher and everyone wants to electrify everything, then you can't store the reserves that you're going to need to, at some point as a nation, deploy possibly into oil, into copper, into commodities. You can't store that in bonds. You need to store that in a reserve asset whose value either stays flat or gains versus oil and copper. And gold has a very long history of maintaining or increasing its value in oil, copper, and other commodity terms. For example, in the last 15 years, oil or gold is up roughly 4x, about 3x to 4x versus oil, and a little over 4x against the Goldman Sachs Commodity Index. And in contrast, treasury bonds are certificates of confiscation against commodities in a peak cheap copper, peak cheap oil world. Now, if the U.S. debt load was modest, such that the Fed could credibly say we will raise rates as high as we need to in order to contain inflation and keep treasury bonds as good as gold for oil and for commodities, then we wouldn't be seeing this switch, in my view. But the problem is with the debt at 120% to GDP and deficits at 7% with near or full employment, the United States cannot credibly say we're going to raise rates as much as we need to stop inflation. They can't. The United States government can't afford much over 5 or 6% on the 10-year. We know that. We saw it last fall. So if you've got a bond that can only raise rates so much in a world where the geology of copper and the geology of oil and global growth in the global south suggests that the prices of those things are probably going to go up pretty notably over time, then you better store more of your surpluses, more of your central bank FX reserves in a reserve asset, number one, that the Americans can't take, which is gold in your vault, not treasuries. And number two, that preserves your country's purchasing power in oil and copper and commodity terms, which is also gold, not treasuries.
So gold, therefore, becomes the leading reserve asset for central banks. I mean, we have seen central bank purchases of gold at record levels in the last 2 years. According to the World Gold Council, central bank net demand totaled 290 tons in the first quarter of this year. That's the strongest start to any year on record. You're saying that as a reserve asset, gold is going to overtake U.S. treasuries. Is that correct?
Yeah, it has for the last 10 years, and it's really blown out in the last 2 since we grabbed Russia's, or since we seized Russia's FX reserves. Absolutely. That's exactly what's happening, and I think it's going to continue.
Let's go back to this idea of the dollar being repriced and not replaced. So repriced according to what?
Repriced based on the trading partner's currency. The dollar is wildly overvalued if you want to reshore U.S. industrial production. If that, and the mechanics of that really, right, is we consider what would happen if we aggressively rebuilt out our defense industrial base. We would need to run bigger deficits. We're already seeing little symptoms of that with what Biden's doing, with what Trump did. You run much bigger deficits, but again, the bond market, the U.S. Treasury market, is 120% debt to GDP. The United States government cannot abide sustained positive real interest rates without creating this debt spiral we discussed earlier. And so if you want to reshore, you're going to need to have the Fed involved, basically capping interest rates one way or another, or Treasury one way or another, capping interest rates. And doing that will be negative for the dollar, in my view. And so mechanically, how it would work out one way or another, in my view.
Which brings us to the question then, Luke, what is your outlook for gold then? And I believe you said that, well, the timeline for this playing out, I know when we chatted previously, you said by around 2030. Is that correct?
I think that's fair. I think the next 4 years are going to be really something because, again, we've got 2 presidents. No matter who wins, they're both going to run industrial policy and they both can't run again. So, like, the time to do this is now. And when you look at what is happening with the rate at which U.S. debt and deficits are compounding with the dollar where it is, the fiscal situation is acute in America. And so that also suggests, over the next 4 years, we're going to see a lot of progress on this front. So I do think it's going to be, I think the world's going to look very different when the next president comes into office in 2028.
So let's go 2030, right? Let's have that as our timeline here. What does that mean for gold prices by then?
I think gold has barely, even with its 30% move higher since November, call it, has barely begun to reflect a reversion to the mean that, if I'm right about it, returning to being the primary reserve asset at the global central bank level. It needs to be made orders of magnitude bigger in price. And something I've highlighted before for clients has been the market value of U.S. official gold relative to the foreign held treasuries outstanding. That's simply market price of gold times 261 million ounces that the U.S. owns as a percentage of foreign held treasuries outstanding. And so when we go back through history, what we find is the long-term average of that ratio is 40% roughly, 40%. In 1989, when the USSR fell, the last time we were in a great power competition or Cold War, whatever you want to call it, that percentage was 20%. And when we had an honest-to-goodness dollar crisis like 1979 and 1980, the percentage was 134%. Now, that is a gold bubble. That meant that foreign holders of treasuries could have showed up at Treasury or Fed and said, give us our gold, and exchanged all of their treasury bonds for gold, and the U.S. still would have had a third of its gold left over. That's a bubble in gold. Fast forward to today, this ratio is at 7%. 7. So gold would need to triple just to get back to the very bottom of this range where we were in 1989, the last time we had a great power competition. Gold would have to rise roughly 6x just to get back to the long-term 50, 60-year average of where it traded in that ratio. And if we, like I said, if we had an honest-to-goodness dollar crisis, gold would have to go up 19x to match the price level it was at in 1980 relative to foreign held treasuries outstanding, which just gives you a sense of exactly how exaggerated the growth in U.S. debt has been and how subdued the price of gold has been since those periods of time.
So, Luke, where does digital gold fit into this picture? How does Bitcoin play into this scenario where gold takes over the U.S. Treasury as the primary global reserve asset, but the dollar maintains its status as the global reserve currency? How does Bitcoin fit into this?
I think it's really good for Bitcoin. I look at Bitcoin as an energy-linked neutral reserve asset for the people. The energy link is the proof of work algorithm where you have to spend a lot of electricity to create a Bitcoin and then to continue to spend electricity to maintain the network. And so it is a digital gold-like instrument in that way. When you then layer over what we're really talking about here, which is increasing periods or more frequent periods of increasing dollar liquidity injected in order to finance U.S. deficits because global central banks aren't anymore. They're buying gold. Ultimately, that means, more dollar liquidity, weaker dollar. That's good for Bitcoin. So I really like Bitcoin as well. It does a lot of things that gold does, arguably better than gold. But again, it's got a lot more volatility. It's a much smaller market. So I think it's everything we've discussed here is very good for Bitcoin.
Do you see central banks buying Bitcoin as a reserve asset?
Maybe someday when it gets a lot bigger. It's just too small right now. But conceivably, there's no reason they couldn't.
And if the dollar's usage continues, right, and the central banks are buying gold, what role do you see Bitcoin playing as a currency, as a medium of storing value? What is the primary function of Bitcoin in this scenario?
I think it's primarily a store of value, a pristine store of value, a very hard and increasingly hard store of value over time. You can then get into discussions of usage as collateral for other markets, reserve asset usage at some point. Conceivably, you could see it move, so to speak, right, to be used as a medium of exchange. But I don't think it makes any sense, or it doesn't make as much sense to use as a medium of exchange until way down the road when the price is much higher and the volatility is much lower. So for the moment, for the foreseeable future, I just see it as a very hard asset store of value with an energy link for the people.
And what about for the still foreseeable future, that 4.5 year outlook that you have for 2030, where you have your potential anywhere from 3x to 6x to 19x gold? What does that mean for Bitcoin in that time frame?
Bitcoin, I think, probably would go up more than gold would in that scenario on higher volatility. So if gold goes up 3x, I wouldn't be surprised if Bitcoin goes up, I don't know, 4, 5, 6x in that world. So I think they can both win.
But why? Why would Bitcoin be going up? You've made the case for gold with central banks, but why do you see Bitcoin even potentially outperforming gold in the scenario you've laid out?
Oh, that's simple. The $130 trillion bond market is the sucker at the card table, and it's going to figure that out. And as it figures that out, it's going to sell bonds, buy me something that holds value. And then that something that holds value will be 65 trillion of US stocks right now, 14 trillion of gold right now, 1.4 trillion of Bitcoin right now. And that process will continue until the bond selling gets so high that it forces Treasury dysfunction, or it forces rates to a point where the US government cannot afford its debt load. And then the Fed and Treasury will come in and print more money to constrain that, which will only feed back into gold, Bitcoin, stocks, the incentive of whatever's left in the $130 trillion bond market to get out into those other assets faster. Wash, rinse, repeat.